Hello, it's Monday, January 2nd, 2012, and this is Brian Shannon from Alpha Trends. Happy New Year to everyone. Let's take a look at these markets here and just try to get a feel for where we are and what we have potentially happening. Obviously, for the year, you've seen these numbers most likely ad nauseum here over the last few days, but the S&P did finish down slightly. Obviously, the financials got whacked pretty good, and the Nasdaq finished up a little bit higher. But really, a lot of indecision in this market. And if you look at a lot of people making predictions about what's going to happen for next year, I've never really been a big fan of making predictions for the year ahead. I think our job as traders is to focus on price action, look at all the potential possibilities, have an open mind for things that are, to be aware that things are going to change. And if you predicted the market was up, going to be up 8-9% this year or down 12-13%, you were right at some point in 2011. But we finished flat on the year, and it shows just kind of the ridiculousness of that, because no one's going to say, hey, I'm buying this stock on December 31st and holding it till next year. That's the volume weighted average price for the year in the SPY. So we finished slightly above it, but just a lot of indecision is what we still have in this market. And we've still got the European fears, we've still got all kinds of stuff going on in the Mid East. Last year we had the US debt downgrade, the tsunami, and all that. So all this indecision, and this year of course we have the presidential election and all the nonsense associated with that. But if you look at the market structurally, what we had in 2011, we had an important level of support that once that was broken with the U.S. debt downgrade was the bigger event for the year. Then we saw this, the massive volatility, and the second half of the year really showed a lot more of that volatility in the gaps. I don't really, again, want to make predictions for next year, but there are certain things I would like to see happen. Just as far as the day-to-day trading goes, it'd be nice to see less of this gappy action and more follow-through throughout the day, rather than having the whole range killed. If we back this up to 2009, here's the volume-weighted average price since the lows of 2009, and you can see that volume weighted average price did act as support at certain times throughout the year, at least on a closing basis through the week. And it's not meant to be an exact number or level, just like anything that we look at when we look at technical analysis. But this market has been battling with the declining 200-day moving average here for the last 2 months or so, and that continues to be really the bigger technical story here, that we have what's been this kind of range in here, and we do still have that inverted head and shoulders pattern set up in here. It's losing a little bit of its validity because we've got this shoulder, we've got the head, and now maybe we're creating another shoulder, just kind of consolidating underneath that 200-day moving average. And the important factor here is we have these higher lows, and if this market can break past about 127.5 ish, then it has a potential to take off from here, I think, to the upside. And as the inverted head and shoulders pattern we've taken a look at prior would indicate, that would give us a target up near about 138 on the S&P 500. Again, that's not meant as a prediction. There's nothing here that has said it's time to buy yet based on that inverted head and shoulders pattern. We have 127.5 to 128 where we have this prior this band of resistance, and we're looking at a 65-minute time frame right now, by the way. But that's our band of resistance. Last week we had a low down near the 125 level, 124.5 really. And if we can continue to hold above that then 124.60ish, I guess. If we can continue to hold above that, that's going to be our important higher low in the intermediate term. But a breakdown through that was going to put us on a stronger defensive stance, I think, and we have to be cautious because we have this what's looking like the lower high here of the last couple days. That we have the lower high, we're kind of battling that 5-day moving average. So it's short-term vulnerable to maybe a deeper pullback down towards the 50-day moving average at 124. If that were to occur, then we're going to need to kind of settle in a little bit further. And again, there's no reason to expect that the market is going to just break down and we're going to go into a new bear market in 2012, or to break out from here. Although it's giving us encouraging signs that if it were, that we have these higher lows, we have some of these moving averages, the 50 and the 100 rising. We've been doing more damage with that 200, and it's giving us more reasons to think possibly we could move higher from here. But it's just not indicated on the shorter time frames or confirmed on the shorter time frames as well. So we've still got a bunch of indecision basically. The Nasdaq is really, although it was up 2% for the year, it was a much messier market than the S&P 500 and continues to be a big giant mess. If you look at this daily chart where we have the 50, the 100, the 150 and 200-day moving average, these moving averages are all just kind of flat to turning back and forth, above and below each other, and crossing moving averages represent indecision, and we obviously knew that anyways. But this massive volatility to get us basically nowhere has, for the most part, frustrated most players in the market this year. We've been up near the decade high and tried to, we're at decade highs earlier in the year, but we've kind of fallen into this just real choppy mess in here. If you take a look at the volume weighted average price for the year 2011, we're basically right on it, and again the flattening moving averages and crossing back and forth show even more indecision. So we excuse me, we've got a big mess for this market, and there's nothing really indicating that that's about to change here in the near term. Let's take a look actually at the 65-minute time frame. We've got a tightening of range, and that will the breaking of one of these trend lines will typically lead to some kind of momentum move, but it doesn't always mean that. It could just be that we continue to battle this 56 level, and that's a big level that we've been focused on. It was support prior support, and then some resistance, and we continue to battle back and forth above that. So it again shows that we can't take the numbers so literally, but it has been, in particular for the third quarter, a very big battleground. The $56 level, when we back it up, we can see it held some relevance earlier in the year as well. But there's just nothing conclusive or decisive about this market right now, whether the date is January 3rd or February 18th or whatever. The fact is, the indecision remains in the market, and that's what we have to look at is we're not seeing any real reason, nothing here to tell us that the market should make this big momentum move in either direction. It's very uncertain. The Russell 2000, when it broke support at that, on the U.S. downgrade back in August, that support has been has acted as resistance, and it's pretty interesting to see. If you're newer to technical analysis, the concept of support broken tends to act as resistance. Basically anyone that bought above this line earlier in the year is losing money, and anyone below it, well, most of them are losing. Most of them are making money actually. But here's the volume weighted average price year to date as well. So let's just clear all that off and take a look at the volume weighted average price again. You can see it's right up at about $76 a share. In that area, we also have the declining 200-day moving average. As we know, we've been battling the 150-day moving average, and we've got this same trend line as far as some recent higher lows over the last several months. But the bigger level here in the Russell is a little bit easier to see in terms of resistance at about 75.5. If this market can push up through that 75.5 level, well, then we've still got this 200-day moving average just ahead at 76.22. So 76.22 is the 200-day moving average. Perhaps we push through that, but this is likely to be a major obstacle at 77. So even if we can push above that, intraday level at 75.5, well, you look at what's up ahead at 77. It's tough to get excited or to think that this market is going to be able to make any substantial upside or meaningful upside. So unfortunately, the calendar changed, but it looks like we have to do what we always do, which is to focus on price action and to learn to be absolutely disciplined and controlled in our share size. It was a tough year for having any conviction. That is 2011 was it was tough to have any conviction in any moves in the broader market. There's obviously always going to be some great individual trades, but if we focus on managing risk and keep that the constant, regardless of whatever market condition we're in, that's what's going to keep us ahead on a not only a relative to what the market's doing basis or relative to what other people are doing, which really doesn't matter, but it's going to allow us to be our best and to make as much money out of the market as we can by taking care of the risk and the market, people say as long as you manage risk, the upside will take care of itself. That's complete nonsense. You still have to manage your winners, and last year was a perfect example of that because you could have had big early gains in the semiconductors. If you started out the year bullish thinking, hey, it's going to be a great year, look at this awesome rally we're starting 2011 with in the semiconductors. But those gains were quickly taken away, and then they went back up again. And obviously, we all know this story of the massive volatility, and we're battling an important level in here as well, 30 and a half. But breaking above or below 30 and a half doesn't mean that anything major is going to happen. We've been above and below this level so many times that it's really kind of it's become almost irrelevant that it's so relevant because nothing seems to happen around that level other than we just keep continuing to gravitate towards it, and maybe that's the reversion to mean trade if you're into that sort of thing. But we've got a declining 150 and a declining 200-day moving average. We've got range-bound markets. These ranges just are frustrating areas where we've got a downtrend line here in these semiconductors. We're at that 30 and a half level. If we break below last week's low near about 30.20, well then it's a good chance I think we head down probably towards 29 and a half. We'll see what happens from there. The bigger losers last year, well not the biggest, but the big loser in terms of the markets that I take a look at here on a consistent basis were the financials. They were down, what did we say, 14%, 18% last year. 18% loss for the financials. If we take a look at the volume weighted average price since the lows of 2009, we're still below that. We battled it and we're above for a little bit earlier this year, but we've got obviously this bigger level in here, this prior support area at that volume weighted average price. That support broken tends to act as resistance, and here again was the U.S. debt downgrade. We're battling this level, which is encouraging, but the bottom is a process. It's not an event. It's not a one-day thing like a top. Sometimes you see that they are quick V-shaped bottoms, but that's the exception. Structurally, we need to get at least above 14 and hold above there on I think several week basis before you could think that this market is really ready to turn. We had a strong trend line last year, and we'll take a look at that on the daily time frame that really held this market back. And then we broke that support, which at about 14 and a half, and then the resistance formed in here. So we're just still, we've got a pretty big level up at about 13 and a half, and that's where we have the 150-day moving average, the 200-day moving average, which is still declining. So it's still guilty till proven innocent on a weekly basis. The markets remain a mess. That's the fact. Nothing's changing because the calendar changed. The only thing you get is a new fresh scorecard. But if you're carrying losses over from last year, the numbers are what the real numbers are, and that you still have to make up for that. Hopefully you were able to make it through 2011 and learn some very good lessons. There's a lot of lessons to be learned, but it's the same things that we know to hold true, which are only price pays, manage risk, and let the trend be your friend. In again, manage the risk as much as you can. So I hope everyone has a great 2012. That even if you had a great year in 2011, that 2012 is even better. Thanks for tuning in.